Hello and welcome to our next lesson today on entry and exit signals. Some of the things we'll be covering in this session include recognizing signals to take action, discussing entry signals and entry styles, and of course, different exit signals we can use when trading. Profitable traders look for several layers of evidence to identify opportunities that meet their criteria. There's a number of situations in the market that may create a more likely scenario to success. So when we identify several layers of evidence, the signals are more likely to trigger an action, and this typically results in a higher probability trade. Always look to trade with the underlying trend. You've probably heard the saying, the trend is your friend. Use a weekly chart to help you see the underlying trend. And of course, the daily chart is used to enter and exit positions. So analyze the weekly. 90% of your trend lines should be drawn in on a weekly chart to establish a trend and your support and resistance levels. Then flick it to a daily chart for your entry and your exit decisions. So support and resistance levels are a key part of what we do. They form fair value price levels where people feel comfortable to open or close positions. Always look for an obvious level of support when looking to buy a pullback. This level will often have a higher chance of attracting other buyers to the opportunity, making it a higher probability trade. So it is a really important step one that any pullback you consider buying in on is at a key level of support. Now that could be a rising trend line or it could be horizontal support. Sometimes it's a combination of the two, but make sure it is testing but still holding support before we even consider the opportunity. Establish a trend line to identify the most recent trend. Wait for the price to break through a down trend line to confirm the potential start of a rally. So this is where we are looking to enter. This becomes a major trade filter to prevent you from buying a stock that is still going down. Always enter as close as possible to the break of trend line to take part in the beginning stages of our expected uptrend. Also tying in with the break of trend line is volume. The assessment of trading volume allows us to ascertain the commitment to the change in direction. An increase in volume is preferable as it breaches the downtrend line, shows commitment to our expected rally. High volume also increases safety in regards to liquidity and commitment. Again, liquidity being our ability to get in or out at hopefully the prices we're looking to get in or out at. Before trading, we need to ensure the market is really moving in the right direction. We call this the signal of strength, or sometimes known as an entry trigger. So an example of an entry trigger might be to enter on the first or second higher close beyond the break of the down retracement trend line. So let's take a look at what an entry signal looks like. So here's an example of an overall uptrending stock defined as a rising blue trend line. So you can see the rising blue trend line is connecting higher troughs, which is showing us an established medium-term uptrend. What we're looking to do is to buy this pullback, also known as a retracement. But to do that, we draw a downtrend line connecting the highs of these bars, or it might be a series of lower peaks, and then we are looking for it to break up through the downtrend line shown here in red. Typically, we'd enter on either the first or the second higher close above that trend line, just depending on how much evidence you want to see of the reversal. Obviously, waiting for a second higher close gives you that little bit more evidence it really is following through and likely to continue that overall uptrend. The problem with waiting for a second higher close is occasionally this will happen. The market gets a little bit excited, rallies very strongly for a day, ends up closing way up there. So the problem we've got now is we've probably missed the boat, and if you bought it there, you'd be entering too late in the trend. So when we look at an entry signal, we are always trying to buy in the beginning stages of an established trend. And that means trying to buy near to the break of trend line. Don't chase the trend, don't enter too late in that trend. So these are examples of retracements and rallies that have occurred from these levels. So here's a classic retracement, which is shown as a downward plotting trend line connecting a series of lower peaks. We're looking to enter on typically the first or second higher close above the down blue trend line here. And that allows us to enter in the beginning stages of our uptrend, and generally is a good indication that uptrend is getting started. And basically you would hold the position for as long as you have evidence that uptrend is continuing. And that could be a rising trend line, for example. And if it were to start breaking down through our rising trend line, we could look to exit that position. So that's the basic concept of how we enter and or even exit a position. Now, looking more closely at how we can enter on a retracement, there are two styles of retracements entries we can look at. The one with the red trend line is considered to be a pretty aggressive entry. If we look at the blue trend line, you see the trend line is a lot shallower. It's also connecting a lower peak, and therefore it's considered to be a safer but more conservative entry. So what's the difference between the two? So over here, if we look on the left, we see the red trend line. Notice what the red trend line is connecting. It's actually just connecting a series of lower highs as this market pulls back. And then we enter on the first or second close above this very steep angled down trend line. So that's a very aggressive entry. The downside to it is you tend to get more false signals. Now, the blue trend line is actually drawn connecting lower peaks. So we're actually waiting for a little counter rally like that, which results in a lower peak. We then draw the down trend line. You can see the trend line itself is a lot shallower. The market has to work a lot harder to break up through a shallow angled trend line. So as a result, if they do break up through these shallow angled trend lines, they have a pretty high chance of resuming that overall uptrend. And you could say we'll tend to get less false signals with that type of trend line as well. Again, entering on the first or even second higher close above that trend line. So there's a bit of a chart showing you those two scenarios. So the red trend line, you could say, is quite steep, reasonably aggressive entry. Look to enter on first or second close above that trend line. Blue trend line is a lot shallower. You see it's drawn connecting these lower peaks. And again, the same sort of entry signal, first or second higher close above that trend line, and in we go. So it boils down to the individual as to how aggressive or conservative they want to be. But again, just remember the more aggressive approach may result in a few more false signals. Conservative traders require just a little bit more proof the market is moving in their favor. So this can be achieved by waiting for patterns like the first higher trough and then breaking the retracement trend line by at least one lower peak. So we want a down trend line connecting at least a lower peak. Ideally, there's a bullish pattern that's setting up there prior to the break of trend line, such as a higher trough, and that's an indication it is being bought up. If it then goes on to break the trend line, it's confirming the higher trough and suggesting there is buying pressure in place. So that would have a pretty high chance of continuing from that level. So what's the higher trough look like? Here's an actual chart which actually shows you this in this example here. So here's the blue trend line connecting a series of lower peaks, so shallow angled trend line, pretty conservative type of trend line. Looking at the price movement prior to the break of trend line, we have a nice example of a first higher trough. So basically it's a rallied followed by a pullback, which then rallies again, forming this higher trough, and just happens to go on and break our trend line. Again, we'd enter on the first or second higher trough, higher close, should I say, above that down trend line. Always trying to enter as close as possible to the break of trend line. This helps you to enter in the beginning stages of our expected uptrend. So your psychological profile will determine your entry and your exit strategies. Just remember, if you're an aggressive trader, you're looking for a faster entry and exit, and therefore you're looking for less evidence of the reversal. The downside to it, of course, is usually there's more false signals. A conservative trader is looking for a slower and more patient entry and exit signal. They're looking for more evidence. At the end of the day, you've got to determine what's right for you based on your practice and competence, trading time intervals that best suit your personality and lifestyle. And some people are just naturally aggressive traders. Other people look for more evidence and would describe themselves as more conservative traders. And everyone is different, so it's important that we find the right strategy that suits your personality and what you're trying to do. All right, let's revisit some of these entry styles. So the most common entry style, the one we've been predominantly talking about, is the retracement. Looking to buy a retracement or a pullback to our overall rising trend line. Now make sure that pullback is well supported. In this case, it's testing the rising trend line, but if you look to the left, it's even sitting on this old peak to the left. So there's some horizontal support tying in with the pullback as it's testing the rising trend line. So one of the most important elements of buying a pullback or a retracement style entry is make sure it's testing but still holding support. And then of course, apply your entry signals before acting on the setup. So draw your downtrend line on the retracement, looking to enter on the first or second higher close above the trend line. Again, trying to enter as close as possible to the break of trend line. This gives you a good price for the stock. Secondly, it allows you to enter in what should be the beginning stages of the next leg of the uptrend. So some basic retracement rules. Always looking to trade with the underlying trend. So that's where trend lines come in, especially on a weekly chart. Start with a weekly chart first, draw your trend lines in, define what the underlying trend is. Flip it to a daily chart for your trading decisions. Make sure your pullback is holding a key level of support. That is quite crucial. It's got a better chance of attracting other buyers to that level and resulting in a more successful trade. Of course, it's important we wait for the break of the short-term downtrend line before entering. Look for good volume at support, but also as it breaks through your trend line, and then wait for your entry signal before you act. And for most people, that might be first or second higher close above that downtrend line. Now, this is another type of entry style that you can incorporate, particularly if you're not overly happy with the retracement. So maybe the retracement isn't as well supported as you'd like. So you're looking just for a little bit more evidence of that reversal getting underway. And that's where the breakout style entry comes into play. So essentially it's pullback in an uptrend and you're looking for it to rally before entering. But specifically in this case, we're looking for a line of resistance for it to break up through. So that means we're looking for at least two peaks like this to draw a horizontal line across. And then we're looking for a first or second higher close above that line of resistance. So it's exactly the same sort of entry technique, but instead of the downtrend line that we would normally enter on a retracement, we're instead waiting for a little bit more evidence it's going up, and we're looking for it to actually exceed the prior peak, in this case breaking through a horizontal line of resistance. Again, you would enter on the first or second higher close above that line of resistance. All right, some continuation breakout trading rules. Only valid in a strong underlying trend. So that is quite important. If you're going to do a breakout trade entry, make sure the trend is strongly up. So trade with the underlying trend, identify a key level of support and or resistance because we need it to break up through that level of resistance before we enter. So wait for that break of resistance. Look for good volume as it breaks through resistance. And the same sort of entry signals can be applied first or second higher close above that level of horizontal resistance. So continuation breakout trading may be considered, more aggressive than the retracement style entry, and again, only valid in a very strong bullish market. Let's start to talk a little bit about exit signals now and ways we can manage trades. So there's a number of ways to determine a directional change in the market. One is a break of trend line. The other is the use of technical indicators such as moving averages. So first up, we're going to take a look at the classic break of trend line to determine a change in trend. So imagine we're looking to trade a stock that's in a sideways channel. We bought it back down here near support. It's rallying nicely upwards towards our horizontal line of resistance. Now we've got two schools of thought here as to how you might manage this. One is simply a profit target looking to sell somewhere near horizontal resistance. The other is a break of a rising trend line. So either of those signals could be used to exit this particular type of trading setup. And of course, if it's a trending stock, the break of a rising trend line could very easily be used. So notice the difference between the trend lines. This trend line here is quite steep. So exiting on the break of this steeply drawn trend line would be pretty aggressive, more short to medium term type trade. Whereas if you exit on the break of this shallow angled trend line, this would be more longer term. So again, depending on whether we consider ourselves short term to medium term, or whether we consider ourselves more longer term as to which of these trend lines you might end up using. You may also consider creating your own unique exit strategy that suits your own style. So for example, selling 50% of your holding and allowing the rest of the trade to run until a break of trend is firmly established. Or simply tightening your trailing stop when you recognize an acceleration in the trend and or you are nearing a predetermined profit target that you've established, somewhere near resistance, for example. So when you become competent in recognizing these simple entry and exit signals, you may wish to add further evidence to your trading plan. So we'd suggest you view the section on advanced indicators to see what else could be added. So examples of that could be a moving average, but there are many other indicators we can use when entering or exiting a trade. So a little exercise you can do at home. Go through your top 200 watch list. Practice entries on both trending and also channeling stocks. Define whether your entry will be aggressive or conservative. And of course, repeat the exercise until both entry and exit triggers become a habit. So get familiar with where you're trying to enter on an uptrending stock or a sideways channel, but also where you're trying to enter or exit within that overall sideways channel or trending stock. Think about how you might manage it, even where you would exit with a stop loss order. Thanks for listening for our lesson today on entry and exit signals.